the Foord General Equity Fund provided stellar returns to investors in 2012, posting a return of 30% for the year. Now, this has further augmented the fund's long-term track record, which now boasts an annual average return of 21% for the last 10 years. Here to tell us why the fund continues to beat its benchmark in such a highly competitive field is Mike Soekoe from Foord Asset Management. Mike, thanks so much. Now, you look at the JSE All-Share rose some 22% over 2012. As we've just put out, you were up 30% over that period. And of course, we want to know the secret to these great returns.
You know, it's quite simple, actually. I think we try and keep it simple. You know, investments, very difficult thing to do, but it's actually quite simple. So you want to buy good quality shares, shares that you want to actually never sell. And that's what we try and do. So when we buy shares, they're shares to go through cycles. We're not momentum players that buy a share, it gets to a 20 PE, and we suddenly want to sell it and try and buy it back 10 Rand cheaper, or when it gets a bit cheaper. If we like management, if we like companies, we like businesses, we want to actually stay with them for the long term. And I think that's what comes out over the long term. So our returns are lumpy, because often what will happen is typically with a share like Aspen, for example, we've liked from 16 Rand a share, but the share doesn't just go up in a straight line. So it looked expensive at 16 Rand, it looked expensive at 45 Rand, at 60 Rand, but eventually it plateaus, and even I think a couple of years ago it actually went down from 60 Rand for a while, and then it starts moving up and it's now 170.
So you hold it through the cycles?
We will hold it through the cycle. We're not going to just sell because something gets expensive.
Mike, you know, we associate many of the lumpy returns from investment portfolios from, in some cases, the style. And I've had many interviews with Dave Foord and asked him, try to pin him down on what sort of style he follows. And it's very difficult to pin, because he does look at value companies, the traditional value companies, and he also is quite happy recently to hold some of the retailers, which many South African investment managers from the value bias were very worried about holding. So perhaps from your side, how would you describe the style that the investment team kind of follows with their stock selection?
You know, I think often you want to pigeonhole asset managers with a different style. They're a value asset manager or a momentum asset manager or a growth asset manager. We neither of those. And I think to put us in any of those pegs would be completely wrong. So what we look at companies and what's their potential 3 years forward. And that's going to be the criteria. So Aspen, for example, was expensive many years ago, but we liked the potential. We liked the strong management team. We liked what they were doing, and we're happy to ride that. The retailers is another example. Just the fact that they've got to 20 PEs, we're not going to go and suddenly go and sell them, or 25 PEs, because the earnings come through at 15 to 20% per annum. Management is excellent. They've got strong balance sheets, good cash flows, all the things we look at. So
but isn't the risk now we're stepping on an interesting debate, because obviously the retailers have been debated long and hard over the 2012, and they're blowing through all valuation models. Are you not concerned that we are heading into a tougher phase for the South African consumer? And if we look at the numbers coming through now, we've got more people going through to debt management, to, you know, people have been spending on borrowed money. That could see an all fall down scenario, or is that not even vaguely in your thinking?
We don't think it all fall down scenario. So we think that there is an element of that where there is this danger. But you know, what you've almost got to do, and what's almost happened over the last 3 years, you've got to look at investments in South Africa from a global point of view. And I think a lot of people try to look at it from a South African point of view. Retailers are too high, 20 PEs, and we want to sell them. But when you're looking as a global investor, you now realize that the 10-year government bond is under 2% in Germany, in the US. So you're looking for companies with predictable earnings, with good dividend yields, with strong management and good balance sheets going forward globally. And that's what's been happening. So your global investor has driven these share prices. And you're right, there could come a time where suddenly growth happens in the world again and interest rates rise, and you haven't got these very low 10-year government bonds. And maybe that's not going to be the sector to be in. But we still think in absolute terms, the retailers are going to do well. So relative to maybe another sector, a growth sector, they might underperform. But in absolute terms, we're still very comfortable with the retailers.
So that would mean that obviously you're comfortable holding them. At what point do you decide to sell a stock, though? What's the thinking about?
We've got no exit levels, Warren. We will try and ride our true worth forever almost. Our Aspens forever.
But what is the signal, perhaps another way to ask that question, what is the signal for you ultimately to sell? A sustained period of underperformance?
Something that's critically changed in the business. If something seems to be going wrong, management has changed, some bad decisions start happening in that business, then we'll relook at it and think, now something's changed. But if we're comfortable with everything, we're not going to sell just because it's got expensive. But what it does, Bronwyn, I think this is another reason why our performance has been so good for a long period of time. We never take one love bets. So even though in 2009 we felt that the rand should weaken, we wouldn't put all our eggs in rand hedges and commodity shares because no one knows the future. So we'll try and balance it, and that's where retailers is so nice. It balances that portfolio. So the rand stayed strong, because 3 years ago it was 850, it's now 870, so it hasn't really weakened. But our retailers did really well for us. So we'll always try and have a portfolio, and you can see from our holdings, we try and cover all bases. So if the rand weakens, we've got non-commodity rand hedges. If China keeps growing and we're still China bulls, we'll have commodity shares there. If the rand stays strong, we've got our retailers. And
so it's about hedging your bets effectively.
Absolutely, Bronwyn. We try and we never take, we're always asking ourselves the question, what if we're wrong? And we know none of us have got that crystal ball. So just cover all bases in your portfolio.
Right. Mark, just to go into the current composition of the portfolio, and just to tie in with what happened in 2012, it's a two-folded question. BHP Billiton and Sasol are the two biggest holdings in the portfolio at the moment. Were those positions added to post-August after Marikana and we had the fallout with platinum and resources kind of went out of favor? Or how are those managed, and have they been core for a long time, those two positions?
Billiton we really like, and it's because we like management, we like their diversity. It's a type of company that's a typical Foord company. So that's been a core holding. It's been our biggest holding for a number of years now. Sasol is really there more as an insurance. It's like our insurance policy. It's not going to have great growth, Sasol, at the moment. You can buy ExxonMobil on an 8 PE. So it's not that exciting, but it's on a 5% dividend yield, and it's very geared to the rand. So if the rand does blow out, it's going to do very well.
Many people who hold Sasol are waiting for that re-rating to happen in the international fund management space, which they believe is going to be a kicker. Is that an outlying scenario for you?
Not really. To us, it's really insurance. So we're still worried about the Middle East. We still think that, you've got the Saudi royal family who got very old, so there's a succession plan coming there. You've still got Iran with their nuclear program. You've got Syria now. And a lot of the countries in the Middle East have taken sides with the different sides of this whole debacle there. So that's still potentially a problem. And it's nice just having Sasol in the portfolio as an insurance in case that blows up and in case the rand weakens.
Mark, just to come back to the company again, and it's one question I've been dying to ask, and I couldn't ask Dave himself because I was a little bit scared about what the answer might be, but he's been in the markets a long time. He's regarded, obviously the company bears his name, he's kind of regarded, I think, by many analysts as being the sort of intellectual driver of the company. What happens in the succession planning of Foord do you have the caliber of people that will follow, that there can be another Dave Foord?
We've got excellent staff, and that's what really is the thing. A lot of people do think it's Dave Foord as the company, but it's a team. And we've got, and all the funds are now managed by more than one person. So this equity fund, there's 3 portfolio managers that manage it. So Dave Foord is one of them. It's a portfolio manager called Nick Balkin and Dane Schrown, all experienced, excellent portfolio managers. So we were very aware at one stage, maybe 5 years ago, it was very much a Dave Foord story. But as we've got depth and we're bringing in these portfolio managers and they're taking some of the management away from Dave, we're relying less and less on him. So I think we will get to the stage where if Dave had to call it a day, which I don't think he ever wants to, I think he absolutely loves investments, he loves this game. I think the succession...
But you've got a sustainable team beyond him.
Absolutely.
I want to talk about Anglo American. Obviously was in the news last week. Mark Kutafani certainly gets my vote as CEO of Anglo American. I see it is one of your big 5 holdings. Has that changed your stance at all? You referred earlier to anything fundamental that changes within the company. Cynthia Carroll to Mark Kutafani.
Well, to us it's a positive. So the same as you, we think similarly. But Anglo's, there's still lots of problems there. That they've got their mine in Chile, that copper mine that's really underperforming. It's not doing well. Minas Rios, that iron ore mine in Brazil. I mean, it's way over budget. It's behind on schedule. So that's a problem. Now,
So he's going to have to go in
so
there
he's
and
got
fix
a
it
lot
up.
to do. And of course, the platinums are under review there at Anglo. So there's a lot for him to do. But we certainly think it's a positive on balance, definitely, his appointment.
Just in terms of, another one on your top 5 is Standard Bank. They're also a story that there's quite a lot happening, and this is where I always find it hard to try and see whether you reinvest more funds into a core holding. Is a company like Standard Bank, which had very big global aspirations. They wanted to be the emerging markets bank of choice. That's now been revised and they've become a lot more concentrated. Has Standard Bank been something that's actually been added to the portfolio?
We have added to it. What's nice about the banks, again, is trying to get that balance. So, for example, if interest rates, suddenly we have growth and interest rates have to rise in South Africa, it's going to be negative for the retailers. But it's quite good for banks because they have what they call this endowment effect. So you've got this lazy money sitting on current accounts that gets 0, and the banks can lend that money out at 8 or 9%. So interest rates go up, they're still paying you 0 on your current account, but suddenly they can lend it out at 12%. And that endowment effect is actually quite material. So when interest rates start moving up, it's actually good for the banks, and it'll be slightly negative for the retailers. So, but it's again, Warren, it's trying to just get that balance right. So the banks on itself aren't that exciting. They're going to grow between 10 and 15%, but they are nice dividend yields, 3.5%. So we're comfortable with them.
Richemont, another one of your top 10 holdings, has been a stellar performer, shooting the lights out. It continues to shoot the lights out, and obviously it's a stay in your portfolio, if I can use that terminology.
Definitely. Bronwyn, we China bulls. So we think the China story is there for many years to come, and you're getting this, the consumer in China is getting richer and richer. They're getting wealthier by the day, and they are spending, and they've got lots of money to spend. So we just think that is going to be a core part of that portfolio for many years. We're still very comfortable with the whole China story and the upmarket luxury goods demand there.
So, I mean, just on the China story as well, the resources are obviously well known. Without talking to other portfolios, is there the opportunity to invest offshore in this country, in this Foord Equity Fund?
No, not in the Foord Equity Fund. It's a strictly rand-denominated, brand-based fund.
Okay, so you'd look for the locally listed resources counters
Yes.
to play the Chinese story.
Absolutely.
In terms of the consumer story in China, Richemont's been one. What are some of the other things you look for in investing in a
company that has exposure to China?
Look, not much more we can do really in the South African context in the equity fund, but in the Foord International Trust, that is one of our themes, the Asian consumer. So we will look for companies like a Diageo, for example, or a Zara, Zara that's in these different, that gets exposure to the Asian consumer, but maybe listed in Switzerland, like a Nestle. So Asian consumer is definitely a theme of ours, but we'll normally try and play it through a share listed in the developed markets.